Hey everyone, welcome back to another Market Open live stream. We've got some more red today. And today we have red because of retail sales indicating a pullback in spending. Broad-based decline too. Out of 13 categories, it was 10 declined. The expectation was for a 0.1% decline in retail sales. However, we got a 1.9% decline, which in my opinion, it sets us up for a quite interestingness in that that sends a signal to businesses, hey, can't keep raising those prices because as we have more inflation, at some point people stop spending. And B, that's probably going to lead to more desires for advertising to make sure that businesses can glean whatever they can or gather whatever kind of profits or money they can. But it's unfortunately in the short term going to be something that makes the market a little sad. Let's take a look at exactly which categories, but also look at the chart here because we had a decline last December as well. So here's our chart. The month-over-month figure, or the black ones here. Excuse me. So in October of last year, October of 2020, we had a 0.1% decline. We had a 0.14% decline in November and a 1% decline in December of 2020. And we just got the numbers for December of 2021. We saw a negative 1.9% decline. What's actually really interesting is if you exclude auto sales, which auto sales also declined in December. If you excluded auto sales, you actually had you had more of a decline. So that means you had more of a decline in the other categories. See, if you're over here, you'll actually see if we exclude autos here, you have less of a decline, let's say in November of 2020. You do tend to get a seasonal pullback in December for autos. We did have a little bit more of a pullback this year than expected as well in auto sales, but also possibly good because there's been an insane amount of inflation for vehicles. Let's see, where are the categories? Categories. I want to see there were three categories. There were three categories that did well. Led by non-store retailers, which includes e-commerce. Those sales plummeted 8.7% from a month earlier. So e-commerce dropped 8.7% from November. Department store receipts decreased 7%. Yikes. Sales at furniture stores, sporting goods, and electronic stores also fell. Receipts at restaurants and bars, the report's only service-oriented category, dropped 0.8%. So what went up? Motor vehicle sales declined. Let's see here. Fewer vehicles on lots for people to choose from. And where are the actual increases? They didn't tell us about the increases? Okay, I'll go right to the Commerce Department if they don't. They gotta tell you the upside ones. They didn't. Okay, fine then. That's funny. Commerce Department, retail sales. Yeah, so there are 13 categories, and 3 of them were positive. So full publication. Here we go. Okay, where are the categories? We'll find them. Anyway, here we go. Okay, December. Well, give us a percentage here. There we go. Okay, here we go. So these are the categories. Where are the positive ones? There's so much negative. Well, that's all I see is negative. So never mind. Oh, there we go. Okay, building materials. Building materials went up 0.9%. So building materials sales didn't have as much of a decline. I wonder if that's almost like Omicron, people staying at home again and buying stuff at like Home Depot or Lowe's, kind of like they did during Delta. You've got 0.5% in health and personal care stores, and miscellaneous stores were 1.8% to the upside. But what the heck is a miscellaneous store? What is that like? Would that be like a dollar store or something? I don't know. See if there's a definition for this. Of course, there's not. Okay. Anyway, All right, fine then. So otherwise, non-store retailers, so online, 8.7% decline. Jeez. Food and service, 0.8. Clothing, 3.1. Sporting goods, 4.3. Furniture, 5.5 for furniture. Nice. Solid declines. Let's see. Let's go to Webull and take a look at some pain. So this morning, we fell down to about 41,787 on BTC, slowly recovering from this low. Let's also look at the indices here. So not so good on retail sales. We've got all of the futures. Wow, they're almost all equal. That's kind of cool. You rarely see that they're all performing approximately the same. All of them down about 0.75%. Bond yields relatively stable, 1.71. But again, today we've got FUD over retail sales, not just bonds going up. All right, fine. So what do we have? JP Morgan. See, everybody thought JP Morgan was going to be the safe one. JP Morgan down 4.45%. I'm pretty sure JP Morgan just reported. So hold on a second here. I want to see JPM's earnings. And it's down 4.45%. So thus is very interesting. I wonder if they fell on trading or loans or both. Because I still think loans are coming in weak. All right, here we go. JP Morgan earnings. Okay. What do we got? So, there's so much. Okay, here it is. Okay, JP Morgan revenue comes in at $29.3 billion. Fourth quarter adjusted rev was 30.35. The estimate was 30.01. So they actually beat on rev. Assets under management up 15%. Book value at $88. Let's see. Where's the pain? So trading revenue. Yep, trading revenue came in lower than expected. 3.33 billion expected. I'm sorry, 3.3 billion actually received. 3.42 was the expectation. So you had a miss on trading. Investment, but investment banking revenue actually came in higher, 3.21 versus 3.08. And let's see. Q4 average loans up 6%, average deposits up 7%. Okay. Charge-offs came in way less than expected, which is good. Only 550 mil set aside for charge-offs versus the 745 expected. Earnings per share came in at a beat, $3.33 versus 2.99. And it seems actually not bad. I mean, maybe because one of the things I think the market might be complaining about is so remember the beginning of the pandemic, the banks, they took credit allowances, which is basically like, hey, we're going into a pandemic / recession. We think we might lose $2 billion on credit cards, let's say, as people default on them. And so they write off $2.2 billion. Let's say they write off $2 billion as an expense. Well, they haven't been needing to actually take all of those expenses. So what do? In a quarter like this, they actually gave themselves $1.21 billion of income back. And when they give this $1.2 billion of money back, it kind of pumps up their earnings a little bit, makes them seem like they made some more money. That would be the only indication I see here of why the market might be frustrated, because otherwise JP Morgan remains optimistic on U.S. growth. Lack of vehicle supply slowed originations for vehicles. Overall, seems relatively upbeat here. What about if we do have a forecast here? JP Morgan sees higher rates and loan growth contributing to 2022 net interest growth in 2022. JP Morgan sees card normalization. Okay, what else here? Yeah. Not much else that's super exciting. We could look at, sometimes this is fun. Watch this. I'll show you. Investor relations. Let me grab this download really quick and we'll put this up. They give you the JP Morgan slide decks, usually not that bad. I generally hate slide decks because I feel like they're just a sales pitch. But the JPM one can tell you a little bit about the econ. All right, here we go. All right, so let's see here. Let's try to scroll to some of the more interesting things. Okay, so here we go. Q4 consumer allowance for credit losses. Yeah, this is where they took some income on credit losses. That makes sense. Less defaults is a good thing. I want to see if I could get credit card spending out of this, because that's going to help us understand a little bit with the retail spending as well here. I mean, look at this. Debit and credit card sales volume was actually the highest in Q4 at JP Morgan. So even though we had this overall negative number on retail sales data, JP Morgan actually crushed it with debit and credit card sales volume. Debit and credit card sales volume up 26%, they wrote here. And then they also have cash in people's accounts. Where do we get that? Let's see. Like average account balance. That's what I would really like to get. Balances, balance sheet. Credit card activity returning to 2019 levels. That's quite interesting. All right, well, we'll have to find it. Credit card average balance has actually gone to about 148. That's down from Q4 19, a little up from Q4 2020. I don't know why this one's falling. It actually doesn't seem that bad. It seems very good. Retail customer. Okay, this is just more bragging about their company. That's fine. Okay, so this is the end of this. Where's, let me see here. Financial Outlook, 2022 Outlook, page 15. Where is it? I'm on page 15. Oh, here we go, page 15. All right, here we go. So this is interesting. And then we got the bell coming up already. Despite short-term headwinds, 17%, I haven't heard this one. Return on total computer. What is this? Return on average tangible common shareholders' equity. Oh, wow. Okay. So they're expecting a 17% return on total common shareholder equity. Wow, that's a mouthful. But anyway, tailwinds, steeper curve and favorable reprice. Let's see. Markets, wallets, headwinds. Continued low rate environment as a headwind. This is an interesting way that they're describing this, because for banks, the lower rates mean less income on loans, right? So they see that as a headwind for themselves. Inflationary pressures on expenses. They're still expecting inflationary pressures. 2021 to 2022, central case, modestly higher rates, loan growth, including card revolving balances. I believe this. I do believe people are going to take out more loans. And this is why I've liked Affirm, because I do think people are going to be borrowing a lot more in 2022, along with advertising. Expense growth, pre-pandemic normalization, and inflationary pressures. Yeah, actually, couple mentions here of still expecting inflationary pressures to continue in 2022. No, it's interesting. No, that's good. It's always good to see what the banks are thinking. Okay, and then this is just bragging about their apps and stuff like that. Whatever. Okay, cool. Let's see what we got here. Is there any green? We'll start over here. Las Vegas Sands, Wynn Resorts, MGM. We must have had a really nice positive report out of here. We can check that in a moment. It is the beginning of earnings season, which is kind of fun. So we'll get to see some excitement in some parts of the market. Hopefully all parts. Hopefully everything gets lifted on earnings, but you never know. Yeah, gosh, JP Morgan down 4.3%. All right, let's listen to the bell. We'll come right back to stocks.
Yeah.
Oh.
Well, we're going to get started with trading here for the day, of course. We're going to hit the opening bell right here at the New York Stock Exchange. guys over at the Real-Time Exchange here at the big board. Robinson Capital celebrating the recent listing of the Robinson Alternative Yield pre-merger.
Wow, that is really red. That is so red. And it's actually just went a little more. Oh, there we go. All right, well, there's your SPY for you. Nice and red. All right, let's go see how the SPY is opening. Let's go to the 1 minute. Okay. It hasn't decided which way it wants to go yet. No problem. Let's see. How about Tesla and its Cybertruck drama? Tesla removing mention of their Cybertruck from their website for 2022. It's worth noting, though, they've talked about this in their earnings calls. This isn't too much of a surprise to me. They mentioned that it's going to be much more likely a 2023 event. So I think it's kind of funny when the market gets so caught up in announcements that were kind of already made, but then they become a little bit more official, and then there's more drama around it. Like somebody earlier today is like, I saw on Twitter, they're like, Elon Musk, you need to have a PR department. It's not fair. Shareholders are getting crushed. And I'm like, my goodness, how long have you been investing? You little baby. Like, the market goes down. That happens. You are not guaranteed. See, I think what the thing is, people make investments and they think, I'm guaranteed to make money. It's not true. Like, investing does not mean you were guaranteed to make money. And so I think when people know that, they become a little bit more accustomed to it's okay to go through red cycles. You know, last year, and this is always, I think, a really good reference point, is I had $2 million in options on Tesla that became $1 million in options. In other words, I lost 50%. I lost $1 million in those Tesla options. Now, I held them. I diamond-handed those things. They were long enough to where the theta decay was bad, but it wasn't too bad. I was willing to wait for the bet that I made. And I'm glad I did, because I out of the 8 options that I had, I pulled a 6-figure profit out of each of them. So probably ended up with somewhere right around $1 million in a gain rather than $1 million in a loss. But I had to sit through that loss for, gosh, that was sitting in my Webull probably from April to October. So 6 months, it's painful sometimes. And it doesn't even have to recover after 6 months. That's the thing. So now it did, fortunately, but yeah. Anyway, wow, JP Morgan. I mean, so many people have been flocking to JP Morgan because they see it as a safe play. And look at this. There's no loyalty in this market at all. Just nobody cares. It's quite remarkable. Whew. All right. Well, let's see here. How are things behaving on open here? That's I mostly want to see if the market is going to keep going red today. Dogecoin up 10% on Tesla finally accepting Doge for products on their merchandise store. Let me look at Las Vegas Sands quickly. It was either Sands or Wynn who reported today. Let's find out. Earnings calendar. JPM, BlackRock, Wells Fargo, Citi. Oh, I actually don't see that Las Vegas Sands or these others reported. Maybe there's some news out of Macau or something. Here, let me see. We will figure it out. Individual company news. All right, Las Vegas Sands jumps the most in 21. Aha! Macau proposes new rules. See, it is Macau news. I knew it. Well, I thought it was earnings first, but when it wasn't earnings, I thought there was going to be something in Macau. So, shares of U.S. casino operators with exposure to Macau rose in pre-market trading after the Chinese gambling enclave released new draft laws that would tighten rules for U.S.-owned casinos in the city. Las Vegas Sands rose 10% in pre-market trading, while Wynn rose 7.8%. The draft law would cut the tenure for new casino licenses in half and require operations to align with Chinese national security needs. but wouldn't reduce the number of licenses in the lucrative gaming hub. An earlier proposal triggered a sell-off amid fears of a crackdown that would reduce the number of casinos allowed to operate in the cities, or in the city. All right. That's exciting for the operators. That is one thing I've noticed, is that a lot of the recovery stocks have done well, except for Wynn. And so finally, you're getting this lifting of the anchor. I think it's still frustrating that there are all these extra rules, but this is good news in the casino world overall, because they don't want to lose more licenses. I do think it'll be interesting, though. I think there's possibly a little too much euphoria coming into the casinos, because they're still going to have to deal with, like they said, the new Chinese security rules and the other conforming rules. I mean, maybe it's just nature of the business, though, at this point. Oh, well. Cheers to green on the casinos. All right. DWAC is up about 2%. Wells Fargo, 2%. Sheeb, 3.9%. Let's see. Lucid. Let's see Lucid here. Some weenie baby yesterday in the comment sections, like, yeah, why does Kevin always gotta talk about shorting Lucid? We should short something else. It's like, chill the F out. The reason, and I've made this I feel like I'm so transparent. A, I don't have any shorts on Lucid right now. B, the reason I talk about Lucid is because it's a company that I feel is most likely to provide the worst news regarding its deliveries. I don't believe the other companies that I either invest in or don't invest in are going to report as bad of news. But anyway, it's rotating back up. I do hope we get a nice little, even if it's short, a nice little euphoric rally would be really nice. We've got a lot of bad news out of the way now so far in the first 2 weeks of January. I'd say the next market catalyst is really the federal, actually earnings. Earnings season is a huge one. But earnings season should be relatively positive. I think the next big catalyst is really going to be the Federal Reserve in their meeting. The Federal Reserve meets on I believe it's the 24th and 26th. Sorry, the 25th and 26th. I will confirm. The 20, no, hold on. Let me get the date right. I'll figure it out. 25th and 26th. Okay, there we go. It's the 25th and the 26th. And they will be another catalyst. However, we do have a substantial earnings set between now and the 25th and the 26th. So, for example, Tuesday, Goldman Sachs, multiple different banks, many banks, my goodness. On the 19th, we have Morgan Stanley, United Health, Procter Gamble, U.S. Bancorp. We've got Thursday, American Airlines, Travelers. When we got Friday, Ally Financial, Schlumberger. Monday, right before the Fed, Halliburton, Royal Phillips, Johnson Johnson, Verizon, General Electric, Lockheed Martin, 3M, American Express. Just reading some of the largest ones. Boeing, AT&T, NASDAQ. These are all none of the consumer ones yet. That's when the Fed meeting is. The next day, you're going to start getting consumer data. MasterCard, JetBlue, Sherwin-Williams, Tractor Supply, Dow Chem, Caterpillar, Chevron, Synchrony. Okay, so that's all January. Actually, one more day in January. Hold on. Then there's Monday the 31st. But there's barely anything on Monday. Okay, good. So, some earnings are going to be a big catalyst. But Federal Reserve coming up as well will be very interesting. I do want to hear what the Federal Reserve says about some of the inflections that we're seeing to the downside in some of the inflation readings. That is PMI, PPI, some energy declines. Are we seeing the larger than expected seasonal declines in autos, and then the consumer spending weakness? So, in my opinion, seeing the Federal Reserve comment on these things could end up being potentially a positive catalyst, because the expectation right now is we're not going to get a rate increase this month. We're planning to finish the taper probably by March and then have a rate left off. But it depends what we get. If we end up getting some form of some form of negativity from the Federal Reserve in that, hey, we're ready to raise rates. Yep, we're going up next, in 2 months. Then maybe that might be a little bit of a negative catalyst. What'll be very nice though is not having to deal with the Fed in February. You're going to have all of February without the Fed. You're going to have earnings. So really you'll have earnings season in February. Earnings season really will go for the first 3 weeks of February. And you'll still have some trickle in earnings the last week of Feb, but mostly it's going to be the next 2 to 3 weeks here in January and the first 3 weeks of February. That's going to be earnings season. That'll be where the dollars come in. And then we'll have the Federal Reserve opine on markets in March again. That'll be quite interesting. But this January meeting, I think, is going to be quite a nothing burger. JP Morgan recovered a little bit here. It's down only 5% right now, so a little bit of a recovery here. Sam Adams recovering a little bit. Disney 2.81%. Shift Technologies 5.56% to the downside here. You've got United Airlines and Delta. These guys down 2.25% over here. Lemonade 1.88%. Tattooed Chef 1.7%. Lemonade 1.6%. These aren't actually horrible declines. The way futures were acting this morning kind of implied that we're going to have a much nastier day today after those retail sales numbers came in. But the market's actually kind of taking this in stride. Let's see here. What's going up? That's so weird. See, and it just shows you the oddness of the market. Look at a firm going for a jog here, going for a run, up almost 4% after retail sales data misses. Like, what? It's honestly comedy. The stock market's comedy in the short term. But you know what? I've always said these are the times that I really like building my longs. Yes, as painful as it is, and I know it's painful. I know it's so much more fun when the market's going up, but markets don't only go up. It's always important to consider that. And it's so weird. We've been through this so many times, but every time the market starts skyrocketing, everyone in the comments is always complaining about, man, I wish the market would dip so I could buy the dip. Then the dip comes, and literally all of the comments are a cluster F. Like, I was going through just to see this sentiment because I want to ultimately make like a sentiment algo, which I do still. I'm going to write that down. I still have the sentiment algo emails that I have to go through. I'm going to write that down really quick. But anyway, you get all this FUD, and it's quite frankly, it's most of the comments turn into this. Just look at some of them here. Hold on, I'll switch this really quick. I'll give you a quick little sample. And again, it's a measure. There are very, very few comments that are actually positive. Extremely few. Like, nobody wants to leave a positive comment because that's just going to get downvoted to oblivion. It's difficult to be positive when times are tough because everything's just negative. So here, look at some of these here. Okay, so market true value 26,000. So shout out to some of the people who are getting their names up here. Kind of funny. This was just from yesterday. They're pretty more. This is an implication that the Dow Jones should be selling for 26,000, which would be a decline from today's price of about 28%. So this is the kind of stuff you see. Fed pumped the market for the past for 10 years forward in 2 years. Okay. I honestly think you are a sponsored grifter by a certain government institution. Say Fed? Yeah. So obviously not true, but this is the kind of pain. These are like lash out kind of things of people having just pain in the market, right? This thing about pulling the market forward 10 years, by the way, in 2 years, by the way, I think is hilariously wrong, mostly because I think corporations have gotten so much more efficient in the way they're manufacturing goods in their supply chains, in the employees that they've kept. I mean, look at this one, folks. Here's somebody who wants to lash out and be ageist about it. It's interesting listening to people younger than 35. They've never really experienced multi-year pain in the stock market. Okay, not true, but okay. You're going to end up under a bridge listening to this dude. It's honestly quite hilarious. And what's interesting is the negativity compounds negativity, right? So what you end up with is inexpensive prices on quality companies that folks are fearful to buy because everyone around them is complaining about the market. When I got into the real estate market, it was the most painful time to get into the real estate market. And it ended up being the best time to buy. And that's what I was doing. I got into the real estate market during pain. I bought homes during pain. And everybody around me said, oh my gosh, real estate. Why do you get into that? Real estate loses so much money. And I always remember thinking to myself, and this is at like 18, I always remember thinking to myself, this is the time to buy. Because if everybody around me is going, oh, I want to buy, then I know it's not the time to buy. It's kind of like right now in real estate, you have this larger sentiment of, oh, I'm going to wait to buy. Okay. You all wait to buy. And then when all y'all finally capitulate, I'll sell. But for now, I'm still very optimistic. I honestly, and some people think I'm delusional, and that's fine. It's okay to have a different opinion. But I have not changed my conviction. Inflation's going down this year, and the economy is, and businesses and the consumer, in my opinion, are quite strong. Even in the face of a decline in numbers here in December. Which some of this personally, I wonder, and I don't know the answer to this, but I do wonder how much of this December decline was the result of a pull forward of spending to October and November. Because remember what everyone was taught about this market, folks. Everybody in this market was taught to place your Christmas orders early because it was going to take longer for your Christmas orders to arrive. I do wonder how much of this consumer decline was the result of this pull forward in spending. Which is very difficult to adjust for on a seasonal basis, right? So that's something to consider. I do want to mention, by the way, we have not decided anything, but it's something that's just sort of been in talks and circulating. If you're interested in potentially learning more about some fund opportunities in the future, from me, or maybe even partnered with some other YouTubers, some great friends, do consider going to metkevin.com/cashflow and just throw your info in there. It's a free thing. It's not a subscription list. There are no emails that go out to that, and there won't be any emails that go out to that until we actually have something to announce. But if you wanted to be the first to know about that, you could go to metkevin.com/cashflow and throw your info in there. Okay, let's go ahead and take a look at a little bit more here about what's happening here. So first, I want to look at the indices here. Look at this, folks. They're recovering. Recovering again. Course member merch drops when, right? So yeah, I'm not partnering with Kathy Wood. No. No. So all of the indices are on a rotation up from the negativity that we had just about 20 minutes ago. What do we have here? Las Vegas Sands win positive on the Macau news. DWAC 3.5%. CrowdStrike at 179. Ooh, It's a nice discount, folks. CrowdStrike right now is selling for April pricing. The cybersecurity ones have really gotten hit. And one of the things to know, and this is something that's just frustrating for, I imagine, these companies, but people regularly throw companies that don't have profit into this bucket of low quality companies, which is really the opposite of, in my opinion, what you should be doing. Because these companies, oftentimes the cybersecurity companies, they show low earnings because they're investing so much in growth. It's really, really quite incredible. But that's just what happens when institutions hedge. Keep in mind, folks, the retail buyer is, in my opinion, substantially less powerful than the institutions, and that's because the institutions can take out substantially more leverage than we can, and amplify their portfolio substantially more. And by doing so, by amplifying their portfolio more, can make outsized bets on shorting companies or taking negative positions to hedge their portfolios compared to what we can do. And so you end up getting, in my opinion, more pain. CrowdStrike affirms up about 2.88, not as high as it just ran. I think it just ran up to about 4% and pulled back slightly here. Let's go ahead and pull the minute. Yeah, look at that. You had a nice little run here, slight little pullback coming in right now. You've got ADA sitting at 125. Hut 8 mining up a couple percent. Robinhood up a couple percent. Also similar kind of little run here at the beginning and then a slowdown. Come on. Enphase. There we go. Enphase, similar movement as well. NEO's at 31. We've really been trading so terribly sideways, if you think about it, on NEO. I mean, stuck at 30 for how long? You know, it's up or down 10% on a day. That's what it feels like. Nvidia coming back to the 270s, sitting at 269 right now. Cloudflare up as well. Let's go grab some news as well here in a moment. Once we get into these smaller moves, it's less interesting to actually look at these. AMC down 4%, under $20 right now. JP Morgan down the full 5%. Nordstrom down on this consumer sales decline. Okay, let's see what we have on Bloom. In space, no one can hear you scream. That's actually a good one. That's a knee slapper. It's under $10 now. Oh. Yeah, this is actually true. It's not just that pull forward. This makes sense. Omicron. What did we talk about yesterday, folks? Yesterday we talked about this right here on screen now, folks. You see what that is? This is a substantial decline in mobility data. Like, here's your Google Mobility Index through January 11th, I believe it was. Straight down right here. And this is straight down following the launch, really, of Omicron here. What I do think is incredible is Delta was right here. Look at that, folks. Mobility getting spanked on the right side here relative to Delta. So we are having less consumer mobility now than we did with Delta. That's freaking nutty. That's quite wild. So that's not, unfortunately, great for the short term. Look, the short term is going to be crap. The short term is really going to be crap. I do really believe, and again, maybe I'm going to be wrong. It's entirely possible. But I really, really believe that we're going to have this bizarre, here it is. I already have it. It's right here. This bizarre fear point where we are right here, folks, where all of the fear is trying to price into the market now, especially Omicron, slowdown. Oh my gosh, China ports more inflation. The Omicron never goes away, or COVID never goes away, blah, 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 blah. All the more fear right now, which means we still have a little bit of pain ahead of us. I don't think a substantial amount of pain ahead of us, but we definitely still have pain ahead of us. And I think the reality is that fear is going to rotate down. It's not going to follow this dotted line of an expectation. We're actually going to have the least amount of fear when rates actually start lifting off And it's going to be, it's quite frankly going to be the opposite of what people expect, the masses expect. And we're going to look back to this time and go, wow, I wish I could buy more at those crazy low prices. Scott Rooney. I am the last of the boomers and have seen every market imaginable. These negative trolls are just that. Keep up the good. Thank you, Scott, for saying that. You spent $5 to lift my spirits. I really appreciate that, because the amount of negativity in the comment sections is so bad, I don't even want to look. But it's so common during these times. I've been through this so many times. Everybody makes fun of you when things are down. And when things are up, it is obviously the most enjoyable, but that's also when it's time to go risk off, right? But that's the irony about my channel, is when things were going euphoric in November, I'm the guy going, hold on, don't go into too much debt, take some profits. I said that for weeks, and then all of the comments are, man, this guy's just a fudster. It's Mr. Fud. He just wants the market to drop so he could buy the debt. You just can't win. All right. So what do we got here? U.S. economy will take a hit early this year from Omicron, but damage shouldn't last beyond the first quarter, according to Bloomberg's latest monthly survey of forecasters. Expectations for growth in GDP for Jan dropped to 3% from 3.9%. Forecasts for inflation, however, were marked up for each quarter into 2023, reflecting prolonged problems with supply chains that risk being exacerbated by Omicron. The new pandemic wave has upended travel and contributed to empty supermarket shelves as workers call in sick. Growth momentum appears to be stalling. Among other indicators, they point to a sharp decline in office occupancy that reversed almost all of last year's back-to-work drive. We expect the Omicron hit the GDP to be short and sharp. You know, that's actually interesting. You know who we need, folks? Okay, hold on. I want to see if somebody can get this without me saying this, okay? Who is the person we need for a short and sharp decline from Omicron? I need the first name and last name. Who is the person that we need? In the meantime, I'll answer this. Calls on Nike, thoughts. Let me look at calls on Nike. And then I want that name. Somebody's going to get it. I'll give it a minute here. All right. It's definitely not Sleepy Joe. No. Who's gonna motivate you that it's gonna be short? There, he got it. Jake got it. Larry Kudlow. We're gonna have a V-shaped recovery. Oh, that's Donald Trump's voice as Larry Kudlow. We're gonna have a V-shaped recovery. I see the V. We're forming a V. Oh my gosh, it's too funny. How long we dealt with that crap. Oh my gosh. Yes, we are in a short-term bear market, Alex. You are not wrong. Okay, so this is actually interesting. You are getting a nice decline, a discount here in Nike for sure. This decline here was, I think, the Taiwanese shutdowns on manufacturing. And this decline here is just the more recent decline. That's fascinating. I mean, I love Nike, and we're sitting at the highs of December 2020 pricing. So, calls could bleed quite a bit, but they could end up becoming profitable in the longer term. If I went out to September of this year, I'd probably go for something in the money. This is the kind of stuff we talk about, by the way, in the course member live streams. You can't be up every single day of the year, but in the course member live streams, we still talk logically and rationally. So if you're interested in logic and reason, consider checking out the programs linked down below, Building Your Wealth. The open interest here is there's very, very little around these low prices, which is very bad for liquidity, unfortunately. I might have to go to Jan 2023 to get myself some options. And seriously, this is not terrible. Not terrible in my opinion. So the $100 call on Nike costs you about $52 right now. That means you're paying about $3.65 for this contract divided by you're paying about 3.65% for this contract. That's not bad. In my opinion, that's actually a pretty good deal for a year contract on Nike. That is not a bad deal. I like that. So thank you, whoever asked, what do I think about call options on Nike? I like that. Hold on. What's the breaking news?
Thanks, Dave. And also business inventories for November. And I want to highlight this because we know we need inventories. November inventories are up 1.3%. And there's been a lot of up 1.3%. You had one in 94, 87, 84. But to find a higher month-over-month change, you have to go all the way back to 1982. So this is a good thing. If you want to be buying things and you look at supply chain woes, inventories are a needed essential. Now, University of Michigan sentiment, January preliminary read expected to be 70.0 is a miss at 68.8. 68.8. That's the lightest read since November when it was 67.4. And that was a 10-year low. Let's go through it, shall we? If we look at current conditions, they were 73.2. That's roughly in line with expectations, sequentially lower than 74.2, our final read for December. If we look at what lies ahead with respect to expectations, 65.9, that's light, and sequentially following 68.3. And finally, the inflation data, always important. The one-year outlook at 4.9%. Keep in mind, It was 4.9% in November, and that was the highest level since 2008. So we equaled that. And if you look at the 5 to 10-year outlook, it's 2.9%. Our last look, it's jumped to 3.1%. To find a higher number than 3.1, you go back to 2011. So we'll basically call it a 10-year high. So once again, we had some misses on the data. But when you look towards pricing, it's been the big story of 2021 moving into 2022. Inflation, inflation, inflation. Morgan, back to you.
Rick Santelli.
God, that's interesting. You know what this is going to do is this is going to do another, this is going to pull a, Kathy Wood right now is doing this. Yay! And the reason she's doing that is because she's regularly been arguing that business inventories are going to create deflation. So I'm not that far, on the other side of that spectrum. Like the spectrum is long, okay? It is very, very long, the spectrum. Here, you know what? Let me draw the spectrum for you. Okay. So here we go. This is the spectrum, okay? On the left side, you have Michael Burry. So this is going to be your Burry, your gold buyers. On the right side, you're going to have your Wood, Kathy Wood. This is the middle here. And then you're going to have Elon Musk is probably over here. And so gold buyers, Michael Burry on the far left. Elon Musk is a little bit more on the left here. I'm going to probably put Jack Dorsey. Oh, probably over here as well. Dorsey. He might actually be a little bit further than Elon. Whatever. It doesn't really matter. Roughly around the same spot there. And so I would probably put myself here. This is where I put Kevin. Whatever. And the reason for that, there we go. Whatever. I can't even get my own name written today. That's fine. So anyway, the reason for that is on the right side, you have this belief that all these inventories are going to lead to deflation. And then over here, and then this is really transitory, right? This is camp transitory. And then over here, you have hyperinflation. Inflation. And this sort of continued pain. Unfortunately, you have a market that does a lot of vacillating. I would actually say the market is mostly vacillating between here. So this is where I think the market is, between here and here. And it's this sort of dance that we're getting, this kind of back and forth right here. So in other words, I actually think I'm more optimistic than the market is. But I don't think the market is as pessimistic as Michael Burry or the gold sellers. So yeah, I don't know. Hopefully that helps kind of explain a little bit. Yeah. So, opinion about where J Pow is. Oh, that's a good one. I would probably put J Pow. J Pow's not a hawk. He's definitely on the right side. I know that. Honestly, I would probably put J Pow even slightly a little bit to the right of me there in terms of being a little bit more towards Kathy Wood. That's probably where I put J Pow. I think I think I'm pretty close to where J Pow is. Where's Nancy Pelosi? I would probably guess that Nancy Pelosi, just based on her trades, is probably even a little bit more this way. That's probably what I'd say. In between you and Wood. Oh yeah, okay, that's kind of what we put. Okay, yeah, all right. So and I think it's nice to visualize it like this because it's so easy to say, oh, somebody's an idiot for being all one side or whatever, and yeah. Okay, good. So otherwise, it doesn't really look like the market's doing some kind of substantial move here. Beyond Meat just moved down about 4.7% though. And you've got some shorter term pain here coming to Disney, Lemonade, Tattooed Chef 1375. EXPI, oh gosh, under 30 again. It was just up 10% like 2 days ago, and now it's been down like 3% in a row, 3 days. Jamie Dimon seems close to the middle, leaning towards Dimon is very optimistic about the economy, but I do think is a little bit more concerned about inflation than Pelosi and J Powell. If I were going to put Jamie Dimon somewhere, I'd probably put him right here. That is, I think he's optimistic, but he's not as as convinced that inflation is going to be as transitory. Like Goldman Sachs, they're probably sitting more over here. Sachs. Those are my guesses there on these positions. All right. Okay. Good. Ross Gerber. Ross Gerber is he's actually probably over here. I don't think he's as far as Kathy based on some of his investments, but he's pretty convinced that we've got transitory inflation. He's more transitory than I am, which I admire. I think it's awesome because I really believe in Ross and Kathy Wood more than I believe in Burry or the gold sellers. And I think Elon's got his head up the manufacturing hole, which I know is like kind of a slam. It is a slam. And I really like and respect and admire Elon, but I don't have to love everything he says. What I mean by that is I think he's overly exposed to manufacturing complexities and supply chain issues. And I think that's giving him this impression that the entire economy is suffering at the same level that manufacturing is suffering, especially when he says that. And then like a few weeks later, they essentially officiate that the Cybertruck ain't coming in 2022. I think that that exemplifies his frustrations. Anyway. I actually am not afraid of being called a bear, Alex. I have hedged my long positions in the past. I'm not right now. The problem I have with hedging is I believe so much in the economy that a hedge is really betting against Train America, right? You're betting against the long-term directional movement of our country. And so hedges require much more timing and perfection than long positions do. Generally, generally hedges are harder to time than longs. So that's more of the thing. Okay, cool. Thank you so much for being here. Appreciate y'all. Go to metkevin.com/cashflow to sign up for like an alert whenever we announce something in the future, when and if. And feel free to check out the programs on building your wealth down below. We'll do a course member live stream